Welcome to eVTOL, the weekly briefing where we look beyond headlines to examine the deeper shifts reshaping the global economy and the technology landscape. Not just the big numbers, but the subtle movements happening beneath them. Some weeks pass without major shocks, yet the world still moves. Systems that once seemed perfectly synchronized begin to slip out of rhythm. Technology accelerating faster than infrastructure can catch up. Robots entering factories before regulations are ready. And soaring demand for electricity and data centers forcing entire industries to rethink how they operate. This week is one of those weeks. Robots are showing up more often on production lines. Data center operators are scrambling for power and land. Companies are adjusting their internal structures to keep pace with new technologies. And the next generation of aviation is advancing ahead of the regulatory frameworks meant to govern it. In this issue, eVTOL takes you through these shifts. From industrial robots and the energy demands of AI to emerging technology platforms and electric vertical takeoff aircraft, to understand how the digital economy is evolving and what these changes may signal for the cycle ahead. The world is quietly splitting apart. The gap between intelligence and energy. If there's a single place to begin this week's story, it's where AI runs into the one limit it cannot escape: power. Not the debate over which model performs better, nor the billion-dollar fundraising rounds, but the widening gap between exponentially growing compute demand and an electrical grid built on far slower timelines. This gap shows up most clearly in very concrete examples. Apptronic's Apollo robot, built with technology from Google DeepMind and Psionic, is already operating inside Mercedes factories and GXO warehouses. Each movement it makes triggers millions of computations on GPU clusters, all of which consume electricity. Power for training, power for real-time inference, power for data transfer, power for cooling the servers behind it. It looks like a robot, but behind it is an enormous computing pipeline that must be fed with continuous energy. The pressure becomes even more visible when we zoom out to the wider race. Apptronic has raised more than $850 million for Apollo. Tesla is accelerating Optimus. Xpeng Robotics is pushing robots into factories, and Figure AI is chasing the household robot. Every one of these ambitions depends on the same bottleneck: reliable power and infrastructure strong enough to support rising compute loads. That imbalance stood out sharply this week when former Bitcoin mining companies like TeraWulf and Cypher suddenly became strategic assets for the AI sector. They possess what every large-scale AI model now lacks: vast land, pre-approved electrical capacity, heavy-duty cooling systems, and the ability to scale quickly without restarting the entire permitting process. Facilities once built for mining Bitcoin are now being repurposed as the backbone of AI. This is why Anthropic, Google, and FluidStack are signing multi-layered agreements with these firms to secure data center space and megawatts. Anthropic has even committed to compute equivalent to 1 gigawatt from Azure, a footprint that industry estimates say could cost up to $50 billion to construct. At that scale, AI is no longer a story about algorithms. It is a story about land, substations, and transmission lines. Power is becoming the new source of leverage. Whoever controls it controls the pace of intelligence. Apollo, a machine designed for automation, illustrates the issue more clearly than anything else. To put a humanoid robot on a Mercedes production line, the entire AI pipeline must follow. Model training tuned to the factory environment, ultra-low latency inference, continuous data synchronization. The robot doesn't consume electricity like an appliance. It consumes electricity like a node anchoring in an AI ecosystem. This gap between intelligence and energy does not erupt into crisis, but reveals itself as a thin fracture, quiet, but stretching further each month. Technology moves at the speed of software, while energy moves at the speed of infrastructure. Tech investment adjusts quarter by quarter. Power grids require years of planning. And when those timelines drift apart, the ground begins to shift beneath us, subtly but persistently. And in those subtle shifts, the shape of the next economic cycle is beginning to emerge. The gap between technology and governance. If AI is outgrowing the power grid at the physical layer, then at the organizational layer, technology is now accelerating faster than corporate governance can keep up. These are not loud disruptions, but small, telling signals that long, stable structures are starting to fall out of sync with the industry's new tempo. Apple is the clearest example. For years, the company operated with clockwork predictability, disciplined product cycles, a tightly controlled supply chain, and a leadership model that barely changed. But this week, signs of adjustment emerged at the heart of the system. Discussions around Tim Cook's succession have moved forward faster than expected, no longer treated as a distant, long-term scenario. John Turnant, head of hardware engineering, is increasingly viewed as the leading candidate at a moment when Apple must redefine its place in an era where AI and personal devices are reshaping consumer behavior. These shifts come alongside other changes in the executive ranks. Jeff Williams has left the company, and CFO Luca Maestri has stepped back from several operational responsibilities. When familiar pillars start to move, Apple is confronted with a fundamental question. Can its traditional leadership model keep pace with the next cycle of technological change? On the opposite end of the scale, but facing the same underlying problem, Grindr is growing faster than its governance structure can support. The company is expanding rapidly, revenue up more than 30% in 2024, free cash flow nearly tripling, and user retention outperforming Match Group and Bumble. Yet its SPAC-era shareholder structure concentrates power in the hands of a small group. When a few high-vote shareholders can influence the entire strategic direction, every major decision becomes inherently fragile. This has led to visible signs of tension, management under pressure to adjust course, large shareholders signaling new demands, and operating teams forced to run at full speed on foundations that haven't had time to solidify. Grindr is becoming a clear example of the gap between market momentum and the carrying capacity of a still maturing governance model. Apple raises the question of leadership transition at the top. Grindr raises the question of structural stability at the base. Both reveal the same underlying truth: technology is moving faster than organizations can adapt. Technology evolves on a logic of speed and constant optimization. Governance operates on a logic of caution, accountability, and negotiation. When these two rhythms begin to diverge, the result is not immediate crisis, but subtle signals: succession meetings scheduled earlier than usual, quiet executive reshuffles, increased shareholder pressure, or growth strategies suddenly questioned despite strong performance. The gap between technology and governance appears as points of tension within the system, moments where organizations must recalibrate or risk being left behind by the industry's new velocity. And it is these points of tension that will determine how companies enter the next cycle, by adapting or by being overtaken. The gap between the future and today's infrastructure. If the first two gaps emerged at the physical layer and the organizational layer, then the third sits at the legal-social layer, the gap between the speed at which technology is pushing the future forward and the pace at which existing infrastructure can realistically respond. It's the hardest gap to see because it isn't measured in megawatts or revenue. It's measured in permitting processes, safety standards, operating rules, or simply a stack of paperwork that hasn't been approved. This week, that gap is most visible in next-generation aviation. Joby and Archer's eVTOLs, electric vertical takeoff aircraft, are being actively accelerated by the U.S. Department of Defense for high-speed reconnaissance missions. For Joby, this is no longer a prototype exercise. Its test facility in Marina is operating. Its factory in Dayton aims for 500 units a year, and several variants are being upgraded to meet longer-range military requirements. After acquiring X-Wing's autonomous flight technology, Joby is integrating sensors and automation systems to move closer to true self-flying capability. Archer is making similar design adjustments to serve both civilian and defense needs, especially as the Pentagon pushes for aircraft that can deploy quickly, operate at low altitude, and run at a fraction of the cost of traditional aviation. From a technology standpoint, everything is accelerating. But on the regulatory side, almost nothing is moving. The U.S. Federal Aviation Administration has yet to finalize certification pathways. Safety standards remain incomplete. Flight corridors haven't been defined, and urban airspace has no rules for hundreds of autonomous aircraft operating simultaneously. The future is already airborne. The legal framework is still in draft form. This gap isn't limited to the skies. It appears in robotics as well. Apptronik, Tesla, Figure AI, and Xpeng Robotics are all pushing robots into real production lines, but deploying robots inside factories requires more than engineering. It requires labor safety standards, inspection protocols, insurance frameworks, and worker training programs. The technology is ready. The social infrastructure is not. Digital infrastructure faces the same constraint. Plans for next-generation data centers talk about gigawatts of power and tens of thousands of GPUs. But electricity, transmission lines, industrial land, and permitting timelines all have fixed limits. When Google, FluidStack, or Anthropic sign multi-layer agreements with TeraWulf and Cypher, companies that once mined Bitcoin, it signals a simple truth. Existing infrastructure cannot match the expansion speed of AI. The gap is also visible in market demand. Transportation, logistics, defense, manufacturing. Every sector is rapidly prototyping an automated future, but most of that future still runs on legacy infrastructure. A factory can test a humanoid robot. An airport can support a few eVTOL demo flights. A data center can add a few dozen megawatts. But reaching ecosystem-level deployment requires far more: laws, standards, power, land, airspace, supply chains, and a workforce retrained for new tools. The core issue is speed. Technology is advancing too quickly, while infrastructure moves at its traditional pace. An eVTOL can receive a software update in weeks, but the U.S. Federal Aviation Administration may need years to issue a new safety rule. The future is clearly modeled. The present is constrained by physical realities that cannot be bypassed. Like the previous two gaps, this one doesn't erupt into crisis. It shows up in small details. Slow approvals, missing standards, unplanned flight paths, data centers competing for power with other industries. But it is precisely those details that will shape the next phase of the technological cycle. Either technology slows down to wait for infrastructure, or infrastructure enters its largest upgrade since the birth of the internet. The gaps that will shape the future. Looking across this week's three gaps, between intelligence and energy, between technology and governance, and between the future and today's infrastructure, a clear pattern emerges. None of these gaps erupt into crisis, but each appears as a quiet fracture beneath the surface. Everything still works, still grows, still hires, still raises capital. Yet within those seemingly straight lines, subtle misalignments have begun to show. AI continues expanding at the speed of software, but underneath it are electricity, land, cooling systems, and GPU clusters moving on an entirely different timeline. Technology accelerates, but organizations operate on steadier cycles. The leadership transition at Apple and the instability at Grindr both show that even the most familiar corporate structures are being forced to adjust to avoid falling behind. And at the legal social layer, bold ideas, humanoid robots, eVTOL aircraft, gigawatt-scale data centers, all must wait for infrastructure, regulations, and standards to catch up before they can operate in the real world. The physical, organizational, and legal layers are now moving at three very different speeds. AI grows on a hyper-accelerated curve. Energy and infrastructure follow multi-year investment cycles. Organizations adapt according to human capacity, and regulation moves at the pace of government. When these four velocities fall out of alignment, they create small but deep gaps, not enough to trigger immediate collapse, but enough to shape the trajectory of the next cycle. Markets can no longer ignore these misalignments. Each gap exposes a long-standing weakness, a power grid that hasn't scaled, governance structures that haven't refreshed, and legal frameworks that haven't updated the rules. An economy can absorb one of these friction points, but when all three appear at once, the world is forced to reestablish its balance. Perhaps the defining question of the next cycle is no longer what will AI change, but where must the physical, organizational, and legal layers meet so they are not left behind by the speed of the future? In the weeks ahead, BizIntel will continue tracking these fractures to see whether they open new opportunities or become the constraints the global economy must confront.